A very good morning to Dr. White and our fellow friends. So today I will be presenting on the topic the impact of bank specific and macroeconomic factors on the credit risk of dozen banks Hong Kong from 2014 to 2023. So this study aims to explore how both internal financial indicator and external economic conditions have influenced the bank's credit risk over a 10 years period. So through statistical analysis, we aim to understand which factors play the most critical role in shaping the credit risk profile of Dah Sing Bank. So Dah Sing Bank, established in 1947, is a well-known local bank in Hong Kong and a subsidiary of Dah Sing Banking Groups. So it operates in Hong Kong, Macau, and mainland China. So mainly serving individual and SMEs. So the bank offers a wide range of services such as deposit, loans, mortgage, insurance, and investment solutions, known for its stable operation and risk-conscious strategy. The bank maintains strong financial health under Basel III and is regulated by the Hong Kong Monetary Authority. Next, problem statements. The main concern facing Dah Sing banks today is credit risk. In 2022 alone, credit impairment loss jumped 115% to 803 million Hong Kong dollar. It's mainly due to its exposure to struggling mainland China property sector. It also suffered a significant 1.68 billion Hong Kong dollar loss from its investment in the Bank of Chongqing. At the same time, digital transformation has introduced challenges like cybersecurity, threat, and shifting customer expectation. Although capital ratio remains strong, this growing credit loss highlights the need to investigate the true driver of credit risk. So this study is guided by three main objectives. First, to determine the impact of bank-specific factors on credit risk of Dah Sing Bank. Second, to determine the impact of macroeconomic factors. And the third one, to examine the combined effect of both bank-specific and macroeconomic factors on the bank's credit risk. So to answer three objectives, this study posed the following research questions. So first one, is there any relation between the bank-specific factor and the credit risk of Dah Sing Bank? Two, is there any relationship between the macroeconomic factor and the credit risk of the bank? And the last one, is there any relationship between the bank-specific factor and macroeconomic factor on the credit risk of Dah Sing Bank? Now, let's look at the key concept from the literature review. So according to Sukma Devi 2020, credit risk is the possibility that a borrower may fail to repay a loan, which can lead to loss for the bank. It's one of the most critical areas in banking risk management. Then, Ghost, Islam, and Hassan 2014 define loan loss provision as a way for banks to prepare for defaults. While it reduces profit, it helps protect the bank's capital. Next, Pratama 2019 introduced Roitalo, which measures how efficiently a bank earns interest from loans. So a higher ratio means better loan performance and lower credit risk. And finally, Koju and Wong 2019 highlight that macroeconomic factors like GDP, inflation, and interest rate can affect credit risk. So good economic conditions reduce defaults, while downturn increase them. So in short, both internal and external factors are important in managing credit risk. In this study, financial data was collected from Dah Sing Bank's annual report between 2014 and 2023, while external macroeconomic data was obtained from Hong Kong official website. The tools used were Microsoft Excel for organizing and visualizing data and SPSS version 26 for running statistical analysis. So the key techniques applied include correlation analysis, model summary, ANOVA, and multiple linear regressions by using the ordinary least square method. So the analysis is divided into three models. Model 1 focuses on the impact of bank-specific factors on credit risk. Model 2 looks at how macroeconomic factors influence credit risk. And lastly, Model 3 examines the combined impact of both internal and external factors on Dah Sing Bank's credit risk. In this study, descriptive statistics were used to summarize key financial and macroeconomic data from 2014 to 2023. Credit risk had a low mean of 1.023% and minimal variations, showing that Dah Sing Bank maintained low and stable risks, indicating good credit management. While ROA averaged 0.869%, reflecting stable profitability, while Roitalo showed moderate income efficiency at 5.1%. About 55% of assets were allocated to loans, and loan loss provision remained low, suggesting strong credit quality. Then, the capital adequacy ratio was healthy at 18.2%, and both the debt to equity ratio and equity multiplier show stable leverage. Externally, GDP growth averaged 1.18% with low inflation, 2.24%, and a stable interest rate at 2.8%. So the exchange rate remains steady at 7.79%. In short, the bank operates in a stable environment with consistent internal performance and manageable macroeconomic conditions. In the correlation analysis, several internal and external variables show strong relationship with credit risk. Regulatory capital ratio R equal to 0.85 and capital adequacy ratio R equal to 0.828 had strong positive correlations, meaning credit risk tends to rise alongside increased capital buffer. The equity multiplier also shows a strong positive relationship, indicating that higher financial leverage increases risk. On the other hand, the debt to asset ratio and debt to equity ratio and leverage ratio had strong negative correlations around negative 0.72. This suggests that banks with better internal risk management system may handle higher debt level without increasing their credit risk. Among external macroeconomic factors, reserve money, M2 and M3 all has strong positive correlation around 0.75. This implies that when the money supply increases, credit risk in the banking system tend to rise as well. However, market risk had a weaker negative correlations, which are equal to negative 0.546 and was not statistically significant. Other variables such as M1, GDP, inflation rate, and interest rate also show weak or insignificant correlations and will exclude from further regression analysis. Next, in the model summary, we assess how well each model explains credit risk using the adjusted R-square value. So the internal model shows the highest realistic explanatory power with an adjusted R-square of 0.949, meaning about 95% of the variations in credit risk is explained by bank-specific factors like capital adequacy ratio, loan loss provision, and ROA. Next, the external model had a much lower adjusted R-square of 0.458, showing that only 46% of credit risk variations is explained by macroeconomic factors such as GDP and money supply. Then, the combined model gave a perfect adjusted R-square of 1. But this is likely due to overfitting and multicollinearity, which can happen with a small dataset. So in conclusion, the internal model is the most reliable and effective for explaining credit risk at Dah Sing Bank. Then, the ANOVA results show that the internal model is statistically significant with a p-value of 0.01, meaning internal factors have a real impact on credit risk. Next, the external model, however, is not significant, with a p-value of 0.196, indicating that macroeconomic variables alone do not strongly influence credit risk in this study. And then the combined model is also statistically significant, with a p-value of 0.012, although the extremely high F value suggests overfitting in this model. Now we go to the coefficients table. In the internal model, there are three variables significantly influence credit risk. Loan loss provision had a p-value of 0.015, indicating that higher provision reflect higher expected default. Second one, retalo has a p-value of 0.041, shows that better income from lendings help reduce credit risk. And the third one, LN size, had a p-value of 0.072, suggests that larger banks may face slightly higher credit exposure due to operational complexity. For the external model, only market risk was significant, which p-value is 0.087 and negatively related to credit risk. So this may imply that more diversified banks can manage market volatility better. In the combined model, five variables were significant, which are rate loan, loan loss provisions, and loan ratios. So these three were strong internal predictor, while GDP, which p-value is 0.036 and exchange rate is 0.02. So these two were the key external factor. And the others variable like inflections, interest rate, and standard deviations were not significant due to the p-value is greater than 0.1. In conclusions, this study finds that internal bank specific factors play the most significant role in influencing the credit risk of Daxing Bank. Variables like retalo, loan loss provisions, and LN size show strong statistical significance in the regression analysis, while most external macroeconomic factors had less impact. The combined model yielded a perfect adjusted R-square, suggesting strong explanatory power, but it could also indicate overfitting due to limited data points. Overall, the bank's credit risk remained low and stable between 2014 and 2023, which reflect solid internal risk management practice. As for the recommendations, future research should include other types of banks like Islamic, foreign, and investment banks to allow for cross-bank comparisons. So using quarterly or monthly data is also advised to capture short-term credit risk dynamic more accurately. So researchers should consider adding non-financial variables like ESG score or management quality to gain a more holistic view. Lastly, adopting advanced statistical method like VAR or non-linear and time lag models can help better understand that deeper relationship between risk factors. And that's all for my presentations of the impact of bank-specific and macroeconomic factor on the credit risk of Daxing Bank, Hong Kong from 2014 to 2023. So thank you for your time and attention.